Good evening, folks. Thank you so much for joining. We'll get started here in just 1 minute. I see folks are still coming in. All right, I think we are a minute over, so we'll get this going. Thank you again so much for joining. We'll be recording this webinar as well, so if you miss a portion of it, we'll share the recording after the webinar. I know it's late for quite a few people, especially on the East Coast. It's already 8 p.m. So without further ado, we'll get this going. So this is our second educational webinar. We've been doing this since last month, and we thought of doing some educational investor-focused webinars for folks who are either new to real estate investing or have been investing in real estate and just want to keep up with the pulse of the market and what's happening. So the last webinar we did was around the fundamentals of real estate investing. And today I wanted to cover just investing in multifamily real estate and what are the key benefits. Now, this is kind of an old topic if you've already been investing in multifamily real estate. So the second part of this webinar, why multifamily still makes sense in 2026, might be of a little more interest to you all if you've already been investing in multifamily. So the first slide is disclaimer, legal disclaimer. I'm not going to read every single word on this slide, but these webinars are for educational and informational purposes only. Do not make investment decisions based on these educational webinars. Please consult your tax attorneys, real estate attorneys, and CPAs before making any investment decision. So with the legal disclaimer out of the way, that's our team here at Prosper Capital. DJ Hume, who's a principal and founder of Prosper Capital, leads operations for us. And that includes our property management side of business and also the construction business. Andy Crawford leads investor relations. He comes from a pharmaceutical background. If you have already invested with us or have been speaking to us about any of our opportunities, I'm sure you have connected with Andy. And I lead acquisitions. I've been investing in real estate since 2019. I came from a tech background where I was working in cybersecurity consulting world for about 10 years, and then jumped into real estate full time in 2023. This is a little bit about us and what we do at Prosper Capital. Again, not to belabor this, I will be sharing these slides as well. But we are a fully vertically integrated company. That means we do everything in-house, from acquisitions to property management to construction. As a company, we've done this for 10 years. We've done 22 plus deals, 5 plus exits. And this is just a bit of a track record, just to show that this is our first rodeo. And we have done this when things were great, and we are still doing it when things are not so great. So hopefully, the content that we are about to present is worth something. Moving on. Okay, now let's dive into the meat of the presentation here. Why multifamily real estate? And like I said, if you guys have already invested in multifamily, this is something that you are probably intimately familiar with. But for some of you who are new to multifamily investing, this would be a good start, hopefully. So first and foremost, what are the key benefits? The first one is that multifamily or apartments, rental apartments, they provide a basic human need. And that by far is my favorite. Because if you are catering to people's basic human need, it is by far as recession resistant of an investment that you can make as possible. The second benefit is cash flow. And the cash flow comes from rental income. So when you collect rental income, expenses go out, the mortgage payments go out, taxes, insurance, whatever's left is your cash flow. Cash flow has dwindled in the recent years because your mortgage payments are going up with the increase in interest rates. But if you manage the properties well, there is still cash flow. Mortgage pay down is the third one, where if you invest in a property, have leverage, meaning loan, your tenants who are paying the rents, they are helping you pay down that mortgage or the principal, and thus you are creating equity in the deal without having to put in any of more of your own money. So mortgage paydown is another great example of a benefit. Then we have tax benefits, which is tax deferral. You cannot really avoid taxes legally, but you can defer them. And real estate provides a lot of tools for you to defer these taxes. So, for example, if you just invested $10 a month over the next 50 years and it was compounding at 10%, you would have $173,000. Now, if that amount was after taxes, which is $7 a month, you would end up with 121, a difference of over $50,000. So if you can defer taxes and compound your pre-tax wealth, you can kind of see how much of a difference it'll make during the course of your investing journey. Then we have hedge against inflation. And what that actually means is typically the rents go up as the prices go up, as the inflation goes up. So your top line income continues to go up as the inflation goes up in the market. Now, that's almost always true. In some cases, it's not true, because in recent years, we are seeing the rents are flatlining, or in some cases, even going negative, although the inflation is still at about 3%. But almost always, the rents typically go up when the inflation goes up. And lastly, strategic forced appreciation. And what that means is with commercial multifamily and in general commercial real estate, you can actually force appreciate your properties by adding value to your properties. And the way you add value to your properties is through renovations. And after renovating, increasing the rents. So your NOI or operating income goes up, and through operational efficiency. So by reducing your expenses. So that is one way to add forced appreciation. So those are some of the key benefits with multifamily real estate investing. So on the next slide, we compare multifamily versus single family home rentals. So for a lot of people, we start our real estate journeys by renting out a single family home. Maybe you upgrade your personal home, and then the old home that you have, you rent it out, and then the rental income starts coming in, then you buy one more home. And that's kind of a common path to a lot of people's real estate investing journey. And there's definitely pros and cons with both approaches. Now, with single family home rentals, they are easier to find, finance, and buy. If you have a good income and also a good credit score, it's pretty easy to go to the bank and get a loan for single family homes. They're typically easier to manage if your single family home rental is in a good location and you put a good quality tenant in it. It's almost DIY, set it and forget it. The tenant's going to take good care of your property. It's pretty easy to manage, right? Except for any major maintenance items. It's easier to sell. You can just list a single family home with any local agent on the MLS. And if it's priced right, it typically sells pretty fast. People are always buying and selling single family homes. And then tenants take upon some of the maintenance tasks upon themselves, like lawn mowing, changing light bulbs, changing HVAC filters, all that minor stuff, which typically you would still have to do as an operator if you had rental apartment. Now, some of the cons with single family investing, it's all or nothing. If it's occupied, it's 100% occupied. But if the tenant leaves, it's 100% vacant. And if it sits vacant for 3 months, well, you're paying for all the expenses tied to that property. So that's taxes, insurance, mortgage payments, repairs, renovations. It's all you. It's harder to scale. You can get up to 10 personal loans to buy single family homes, but you cannot get any more. Now, of course, you can bundle them up in a portfolio loan, but that again is a commercial loan. So scaling a single family portfolio is a lot harder and slower than scaling a multifamily portfolio. There is limited opportunity or almost no opportunity for forced appreciation, because the value of your home is determined by the home value of your neighborhood. So essentially, it's based on comparables approach. So when the property gets appraised, the appraiser looks at 5 to 10 homes near your home that's about the same size, same finishes, and the average of that value is basically what your home value is. So you have no control over the home value. So if the market's doing great, your home value is appreciating. If the market's not doing so great, well, your home value is tanking, and there's really nothing that you can do about it. Lower rent to expense ratio, what that means is rent compared to the expenses is usually a little bit lower. So if you're lucky, your rent will cover all your expenses. In most cases with single family homes, the rent does not even cover all the expenses, meaning you would be in a negative cash flow situation. And if you're in a negative cash flow situation, it's not really an asset. By definition, an asset should produce positive cash flow. And even if your single family home produces positive cash flow, the cash flow is not as healthy as you can get with commercial real estate. Now, on the flip side, if you look at multifamily rentals, apartments, typically the larger multifamily, 40, 50 and up, you have economies of scale. You have more units. So if you buy, let's say, 100-unit multifamily building, 10 people leave, 90% still occupied. There's still 90 people in there paying rents, and that's enough to cover your expenses. The property is still cash flowing. It's easier to get unlimited loans because these are typically non-recourse loans, and the property itself is used as a collateral. As long as the income produced by the property can service the loan, you can continue to get more and more loans. And that's how the big real estate investors like Donald Trump continue to build massive portfolios because there is no limit to how many loans you can get. There's better cash flow, as I just mentioned. There's forced appreciation, which is through renovations, proper management, improving efficiency, and operational value add. You have opportunity to hire professional third-party management. So typically, if you try to hire management for single-family homes, you will find that most managers are ad hoc, but there are large property management companies, institutional-grade companies, that are available to manage large multifamily assets. And then finally, you get a lot more tax benefits with large multifamily assets, like accelerated depreciation, 1031 exchanges, where if you sell one property, you have the profits, you can reinvest all of those profits into the next deal, and you can thereby defer the taxes. Again, it's all about tax deferral. You cannot legally avoid taxes. But if you continue to play the game, you can continue to defer those taxes really forever. Now, on the flip side, what are the cons? It's more expensive to buy. A 100-unit property would be about $10 million, which means you would have to put down $3 to $4 million. And not everyone has $3 to $4 million to put down. So how do we buy these deals? We buy them collectively in partnerships. We raise capital from investors. We go buy the deal. Some people put in the work, some people put in the money, and some people share everything. You need a proven track record to buy these properties. So when a bank is giving you, a $7-8 million loan to buy this $10 million asset, they want to see, have you done this before? Or is this your first rodeo? If it is your first rodeo, then you may have to put down more collateral. You may have to bring in guarantors who have actually done this type of a deal before. So you need some experience and track record. These deals are typically harder to find. Not saying that all the deals on the market are bad deals, but typically they are. So if you want to source really good quality deals, you need to have broker relationships or a good deal flow from a direct to seller method, which requires a lot of time, energy, effort, and marketing budget. So it almost becomes a full-time job to source high quality commercial deals. And they're management intensive. So of course, managing 100 units as opposed to a single family home, it is going to be more management intensive. But of course, your numbers are going to be a lot bigger, collections are going to be bigger, and your profits are going to be larger as well. Moving on to the next slide. Now we talk about the history of rentals and the supply and demand equation. Now, this chart is a little bit older, but the story hasn't really changed. Home ownership in the US is dropping consistently year over year. There's two main reasons for that. One is affordability. The income is not really going up by that much. However, the home prices continue to stay pretty darn high. The other reason is the Gen Z is actually preferring to rent homes. That way they don't have to deal with all the headaches that come with home ownership, the maintenance issues, paying for taxes and insurance. They just want to live in a nice apartment, have the landlord worry about everything else. And also the Gen Z likes to live a nomadic lifestyle where they would want to live 3 years in this city and then 2 years in a new city and switch jobs. And for those reasons, home ownership is actually declining. At the same time, rentership is actually going up. But if you look at the supply side of the equation, in the 2010s, the supply fell off of the cliff. It slightly started to come down right after COVID, after the interest rates dropped. But then in 2023, interest rates went back again by 5.25%, and construction again came pretty much to a standstill. So the supply demand equation is pretty much in favor of the landlord. So if you have rental properties and there's limited supply, but the demand is strong, you are in a good position. And overall, in the US, there is still a tremendous shortage of housing. In some markets, there is oversupply. There are some markets that are a little bit overbuilt, like Phoenix, Arizona, and Austin, Texas. But that is more of a temporary thing. People are still moving into these cities, and the oversupply is going to get absorbed in the next 18 to 24 months, and the supply and demand equation will be balanced again. So overall, that is good news. Now, the next reason why multifamily makes sense, we already spoke about hedge against inflation, and how does that really work? First, we spoke about the rent increases. So the rents typically go up as the inflation goes up. So if you look at the last few years, this is the inflation line, and the red line is the rent line. So the rents have actually outpaced the inflation. Now, this changed in the last 2 years or so 2023 to 2025, where the inflation was still strong, but the rent actually was either flat or negative in certain markets. In certain undersupply markets, the rent was still positive. But that was all because of the supply and demand equation, like we spoke about on the previous slide. And when the supply actually catches up with the demand, and then slowly the demand starts to outpace the supply again, we will again see that positive rent growth. And typically, if we look at the last 3 decades, rent always outpaces inflation. And which is why it's a great hedge against inflation, where your income always either keeps up or does better than inflation. And the other aspect is the replacement cost. So if it took $10 million to build an asset today in 2026, it's going to cost you maybe 10.5 million next year, 11 million the year after. So the cost of construction goes up as the cost of materials goes up. So when you buy an asset, the replacement cost of that asset continues to go up. And because the replacement cost continues to go up, the value of your asset also continues to kind of go up. So those two are the aspects why multifamily, or in general real estate, any commercial real estate, is a great hedge against inflation. The next one is market appreciation. Now, this is a little bit different from forced appreciation. We'll talk about that also here on a separate slide. But when we talk about market appreciation, it's just the appreciation that the economy and the market provides you. Appreciation is essentially an increase in the value of the asset over time. And that increase can occur due to a number of reasons, right? When it comes from the markets, it's typically because of a strong supply-demand equation. So if it's weakening supply and there's a strong demand, now you can start to increase the rents. And if you increase the rents and your NOI, the value of the property goes up, and thereby you have appreciation as a result of changes in inflation or interest rates. So typically, as interest rates go down, the values of the properties go up. So they are inversely proportional. In the recent years, the interest rates went up, which is why we see the property values have come down in the last 3 years or so. But the interest rates are not going to stay high forever. They'll probably stay high this year, but next year onwards, they will slowly start to again come down. And what that means is the property values are going to start to go back again. So if you look at 2020 or 2000 through 2025, and compare the returns overall, commercial real estate produced an average return of 18.85% annually, while S&P 500 produced 8.7% annual returns. So when you're investing, you always need to look at long-term perspective, because real estate is a game of patience. If you're a day trader, you're probably not going to invest in real estate, because these are all long-term plays. I know the stock market is rallying right now for the last few years, but if you look at long-term 25-year perspective, real estate has always produced much better returns annually as compared to S&P 500. So moving on to next slide. And if there are any questions, feel free to drop them in the chat box. That way I can try to address those questions as they come up, or maybe towards the tail end of this webinar as well. So moving on to the next benefit of multifamily, and that's cash flow. So we kind of touched upon this. So cash flow is everything that's left over, which is basically your profit, after operating expenses and mortgage payments have been taken out from all the collected income. So cash flow was about 7 to 10% with commercial multifamily up until 2023. But now that the mortgage rates have gone up, your payments have gone up. And typically what we see today is that cash flow at acquisition or when you buy the property is typically around 4, 5, 6% if you're lucky. But as a golden rule of thumb, it's okay to buy a property as long as at least it is cash flow positive. If you know you can add value to that property and increase the income during your ownership. If the property is cash flow negative, then it is a dangerous play, and I would not recommend pursuing a property that cash flows negative, because that way you're losing money month over month. So we try to increase the cash flow basically through physical value add, which is through renovations. So improving the condition of the asset. Once the asset is in a better condition, the units look nicer, you can increase the rents and thereby increase the income and increase the value of the property. And then operational value add, which is a good property management, reducing the expenses, adding other income, RUBS, and charging for utilities, and just implementing processes and systems that prevent from things from slipping through the cracks, managing deferred maintenance, and just being proactive and managing your expenses. Okay. Moving on to next slide here. Now we are going to talk about forced appreciation and a little bit more detail about that forced appreciation. So what does forced appreciation mean and how does it really work? So again, when you're looking at single family homes, those are valued based on comparables. So if you're buying or selling a single family home, the appraiser is going to look at single family homes around your area, similar size, similar vintage, similar upgrades and finishes, see how much they were bought and sold for in the past 6 months. An average of that is going to determine the value of your single family home. However, the value of commercial multifamily or any commercial real estate is based on NOI and something called as the cap rate or capitalization rate. What cap rate in simple term means is that if you buy the property in cash, what returns are you going to get? If it's 6% returns, that becomes the cap rate. It's 6%. So the value of the property is NOI, net operating income, divided by cap rate. And NOI is the total income that the property produces minus operating expenses. But NOI does not include mortgage payments. Okay, so total income minus operating expenses, except for mortgage payments. And cap rate is purely determined by the market. And other factors that drive cap rates is interest rates in the market and overall economic growth. Now, how can we actually add forced appreciation to the property? So if you think about forced appreciation, like I mentioned, there's 2 ways to force appreciate the property. One is through increase of rental income and thereby increasing your NOI. And the easiest way to increase your rental income and not relying on just the market rents going up is to actually improve the overall condition of the property, so renovations. And then the other way is to actually improve the efficiency of the property or operating the property well. Some of the other ways would be to add other income to the property. So like charging for storage units, charging for parking, charging for utilities, etc. That improves the income of the property. And then you can start cutting down expenses through better operations. You increase the NOI, which is the numerator in this formula here, and thereby you increase the value of the property. Now, cap rate is out of your control. So if the cap rate is compressing, meaning it's going smaller and smaller, your property value is going up. So even if you didn't increase the NOI, but the cap rate was automatically going down, the property value is going up. And this is kind of what happened in especially 2020 through 2023, where people were buying properties, not really making much improvements. They were running them about the same, if not worse, but the cap rates were going down, the values were going up, and everybody looked like a rock star. Now things have changed. And now you really have to focus on your NOI and underwrite for cap rate expansion to be able to make money in multifamily. But forced appreciation is still possible irrespective of the market condition that you're in. And this is just a quick example of that forced appreciation value add strategy where you take an old looking unit, renovate the unit, improve the condition of the asset. Previous rent was $800. The new rent is $1,250. You just improve the rent by $450, multiply that by 100 units, you significantly increase the income. And this is the value add strategy through renovations. On the flip side, of course, you have to make sure you're operating well and you're cutting down expenses, putting together good systems and processes. That way you have a handle on both sides of that equation. And that's why you can actually increase your NOI significantly over the 5 to 7 years of asset ownership. And oftentimes you can actually double or triple the value of your property. So that, in a nutshell, was a summary of why multifamily makes sense. I'm looking at the participant list here, and I believe almost everyone on this call has invested in multifamily before. So that was kind of repetitive information for a lot of you people. But now, looking into the 2026 outlook for multifamily and the way we are approaching multifamily investing in 2026 and really in the next year, 2027, and perhaps 2028 as well, because we don't see things changing drastically in the next 2 to 3 years. As we all know, markets are extremely uncertain and unpredictable right now. Multifamily as an asset class was a rock star of an asset class until 2023. The market softened, the returns were not quite there, and all that money that was chasing multifamily is now chasing other quick profits and other returns that are a little more quick. But in general, multifamily has always been a long-term play. And the 2022 through 2023 quick profits that people saw is not the usual. It's not the norm. So now, before we dive into multifamily outlook for 2026, let's also talk about some of the other investment classes that are available and how are they looking like, starting with the stock market. So if you look at the stock market, if you look at the chart, the stock market has gone up and down multiple times. Every gray line is basically either a major or somewhat of a recession, right? So stock market is not necessarily predictable. A lot of people think that stock market over the long run, S&P 500 over 40 years, 30 years will always be in the positive. But I would question that assumption. We have some more slides where we can actually show how S&P has performed during certain 30 and 40-year intervals. If you look at the stock market today, the price to earnings ratio is pretty high. It's at 28. And if you look at the rule of thumb by Warren Buffett, who probably is one of the best investors till date, if it's over 22.5, he usually doesn't like to buy because the stock market is overly inflated. And essentially, PE ratio is the market value per share divided by the earnings per share. So if you look at this S&P 500 today, it's definitely at an all-time high. So is it a good time to enter the market today and expose significant amount of your savings to the stock market today? I would definitely question that. Most of the market growth is really coming from one place, and that's CapEx investments in AI. And most of those investments are funded by petrodollars from the GCC countries. And if you look at today, what's happening in the GCC countries, they are war torn. So if they have to make a choice where to put their investment or petrodollars to work, they're going to put those dollars to protect themselves first before they fund America's AI race. So will we continue to see the same type of investment in AI that we have seen in the last 2 years? That is questionable. And AI companies actually are not producing profit today. All of the valuations and investments are based on future profit and future growth. So that's a lot of speculation in the market today. Now, this chart is S&P 500 chart adjusted after inflation. So if you look at this chart from 1880 to 1920, that's 40 years. If you started in 1880 and ended in 1920, your return after inflation was zero. So imagine putting all of your wealth in a 401k fund in 1880 and you retired in 1920. You basically made nothing in terms of returns. Same thing happened again in 1955 through 1982 or so, over 25 years, 0% return after inflation. So you have to consider that possibility that you could actually have almost zero return by the time you retire in 20, 30, 40 years. And which is why I think it's important to diversify. Let's take a look at what's happening in private equity or private credit markets. I mean, you all may have seen these headlines about $265 billion in private credit meltdown. BlackRock, Blue Owl, they have all basically limited or frozen their withdrawals. And the exposure is huge, $3 trillion invested in private equity markets. And what private equity or private credit means is that if some businesses want to borrow money, but the risk levels are too high where the banks are not lending them money, they get this money from private credit at extremely high interest rates. So when those loans are being serviced and everything's going fine, private credit and private equity can return phenomenal returns, 18, 20% returns easily. But when things are not going well, that's when we have problems. So, which is what we are seeing now. Now, what about gold? We are seeing gold prices rallying. And what happens is when prices start to climb like crazy, that's where the money goes. It's the herd mentality where people just start to invest money in things that are just going up in value, and they continue to invest as the values peak, and we end up selling when the values drop, which is the opposite of obviously what we need to do. Be greedy when others are fearful, as Warren Buffett has said. But we are seeing the exact opposite again with gold. Does gold always retain value or grow in value? Does it always appreciate? Well, we can see here from 1980 to up to almost 2008, the value did not really go up. So, can it be a store of value? In some cases, yes, it can potentially be a store of value, but it's not an asset. It doesn't generate positive cash flow. The money is just going to sit there. So it's not truly an asset. So keeping a small portion of your portfolio in gold makes sense, but overexposure to gold does not really make sense either. And it's not portable either. So in a doomsday scenario, if you have tons of gold, you can't actually travel with gold if you have a gold bullion. And if you have gold ETFs, now technically you don't have gold, you have paper assets, right? You have derivatives. Now let's talk about Bitcoin. A lot of people have been investing in Bitcoin. Some people got into Bitcoin, lost some money. The first time there was a rally, 2019 to 2021. Some people started to go back into Bitcoin when Bitcoin almost crossed 126K. But it's a highly volatile and very speculative investment class. I wouldn't even call it an asset because, again, it doesn't cash flow, but it is very, very volatile and very speculative. So am I saying do not invest or put money in Bitcoin? No, but you need to be diligent about how much exposure you have to Bitcoin as well. And now Bitcoin has gone from 126K to about 67K in just a matter of few short months. And finally, what about saving cash? Just sitting on cash. We don't know what's happening in the market with the war, overly inflated stock market, job losses from AI. Maybe we should just sit on cash. But unfortunately, savers are the biggest losers, because if you sit on cash, you're losing about 3 to 4% every year due to inflation. So your purchasing power of every $100 or $1,000 you're saving is going down by 3 to 4% every year. So saving cash is also not much of an option. Sure, you can hang on to some liquidity and some cash as your rainy day fund, but keeping too much money in cash is also, honestly, a pretty stupid idea, because you're guaranteed to lose if you hang on to cash. There's more uncertainty, as I mentioned, coming from Iran war and the AI impact. We've been all reading about closing of the Strait of Hormuz, which has led to higher gas prices. When the energy prices go up, inflation follows. We are already seeing it at the pump, but that's only the first impact. We are going to see it throughout everything else, because petrochemicals and gas drives basically everything. The food that you put on your plate, it took gas to bring that food to your grocery store. So everything is over time going to go up. At the same time, the labor market is kind of weak. We actually lost 92,000 jobs in the month of February, while we were expecting to add 60,000 jobs. That's a 150,000 job delta. So that's not looking very good. And the Feds have the most difficult job in the world. I mean, they have a dual mandate where they have to control inflation while protecting the labor market. And the only lever they have to pull or push is interest rates. So we have seen the interest rates steadily come down since the sudden peak by about 525 basis points in 2023, but they have not come down to COVID or pre-COVID levels. I mean, they are still fairly high. If you're looking at bank loans, they're at about 6 to 6.5%. Same thing with agency loans, and the prime typically is at about a little over 4. But at the same time, if you look at the 10-year Treasury yield, which is the bond market, it's actually going up. And why is it going up? Because 10-year Treasury yield is dependent on how much demand there is in the market for the US Treasuries. And with the dollar losing a little bit of faith in the world market today, and China and Japan dumping the US dollar, the market is demanding a higher yield on 5 and 10-year Treasuries. So now we are in a pretty precarious situation where the Feds cannot really reduce the interest rates because that will cause an uptick in inflation. And they cannot raise the interest rates because that will further weaken the labor market. So which is why we do not foresee any changes in interest rate, any major changes in interest rates in 2026 and maybe even 2027. Okay. So uncertainty is everywhere. That's the bottom line. So where should we invest? So if we look at what the ultra high net worth and high net worth individuals are doing, this is coming from a survey that was done by a community called Long Angle, which is a community of all high net worth individuals. They are investing their money in a broad range of asset classes. The biggest one being the stock market, 57%, private equity, real estate, alternative investment, which includes Bitcoin, etc., bonds, and then cash and liquid investments. So diversification is really the answer for most people. That is the correct answer, because that way you're not overly exposed to any one asset class. Now let's compare all of that with multifamily, including multifamily in 2026. So we saw all of those charts of the stock market, of gold prices, of Bitcoin prices, and we saw how up and down they were all over the place, which is just basically making a statement about how volatile all of these other asset classes are. Now, in comparison, look at the cap rates for multifamily, which is really the only market-dependent factor that drives pricing for multifamily real estate. And sure, you do see ups and downs, but it is relatively smooth, even, and relatively flat. So it's not changing on a day-to-day or month-to-month basis. And that exactly is what we love about multifamily and in general real estate or commercial real estate, is because you have a long-term horizon, you see what's coming, and you can make business plans based on what's coming. So if you look at the cap rates, they peaked in 2008. So at a higher cap rate is actually a good time to buy because that's when you can buy properties at a discount. The cap rates were compressing slowly and steadily until pretty much 2022, which is why everyone was buying properties, selling them, buying them, selling them, and making a huge profit. Everyone was looking like a rock star. Multifamily was attracting capital like just anything, right? Money was just chasing multifamily deals. But then interest rates went up, cap rates expanded, and now we can see in 2023 and early 2024, they actually peaked, right? And that was kind of this small recession for multifamily. I mean, we are still not in a depression, but we are definitely in a recession. Cap rate expansion happened, price correction happened, the prices went down. So if you bought multifamily in 2021, and if you're trying to sell it in 2023, well, boy, oh boy, you're in a tough spot, right? Because even if you did all your best to increase that NOI, the cap rates are hurting you. Is that the end of the world? For some, it is. But if you're a good operator and if you can hang on to that asset, if the asset is still cash flow positive, you can ride this wave, hang on to that asset, and wait until the recovery continues to happen and sell the asset when the cap rates come down. Will the cap rates come back down to COVID levels? Maybe not. But if you have done a good job as an operator, increase the NOI well enough, even if your cap rates have gone up slightly, you can still have very much a profitable exit. And all sources, including all the economists in real estate, like John Chang from Marcus Millichap, Jay Parsons, Bob Fraser, all the big names, they all agree that we are already in a recovery phase. However, everyone also agrees that it's going to be a slow and painful recovery. So people who were so used to seeing quick profits, well, it's disappointing news. The time to make quick profits in multifamily is gone. But that does not mean that there are no longer profits in multifamily. So if you are looking at long-term horizons, 5, 7, 10-year plans, and if you know how to operate, there are still healthy profits in multifamily. At the same time, the risk levels, as we've all seen, clearly are a lot lower as compared to some of the speculative investments that have gone all over the place. Let's look at the supply and demand equation. So the supply and demand equation is still very much favorable, right? There's still housing shortage overall in the US. In some markets, there is oversupply, but even that oversupply is now being absorbed. So even that is a positive news. So all in all, if we have to sum this up in just a few key bullet points, our take on multifamily in 2026 is to focus on value add B class for forced appreciation. Stay away from stabilized properties with no value add potential, especially if they don't provide strong cash flow day one. So if you find a great turnkey property, but it cash flows 7 to 8%, and it's in a great location where you will get some market appreciation because of just how good the location is, sure, you can go for it. But other than that, if the property doesn't provide strong cash flow, stay away from that property unless it has some value add potential. Stay away from C and D class properties because they just add another layer of risk. And as the affordability crisis continues to worsen, these are the areas that are going to be the worst hit. C class assets typically have more maintenance and more repair bills, more deferred maintenance. So it's a good idea to stay away from those right now because there's not a whole lot going in the market that's going to help you overcome some of the mistakes that you might make with C and D locations. 2026 is going to present pretty good investment opportunities and buying opportunities only for the strong operators. We are already seeing a lot of the operators are not even operating anymore. People who didn't know how to run these properties and actually put in the blood, sweat, and tears to improve these properties are already out of business. But if you are a strong operator, there are great opportunities out there. There are many failed deals, failed value adds, people who did lipstick on a pig renovations, hoping that they will get great value for their property. All of those deals are failing, especially those deals that were purchased on bridge debt, which is floating interest rate debt, right? So as the rates went up, these properties are now in trouble. Conservative underwriting is always important, but it's more important now more than ever. So rent growth, I've seen underwriting models with 5, 6, 7, 8% rent growth, but I think sticking to a more conservative 2 to 3% and maybe even flat rent growth or zero rent growth for the first couple of years is the way to go. Cap rate compression, I would not assume cap rate compression, which means cap rates going down, at least for the next couple of years. I would assume cap rate expansion. And in general, that assumption is always a good rule of thumb. If you're buying at 6 cap, always assume at least 50 basis points or 0.5% increase in the cap rates by the time you exit. So exit cap rate of 6.5 at the very minimum. Vacancy rates, we have to be very careful with those. The vacancy has ticked up in the recent years. So having a vacancy rate of 8 to 10% at the very minimal. It's conservative. If you have more vacancy rates built in, it's even better. Expense increases, insurance taxes are going up pretty fast. So you got to be cognizant of that as well. The era of flipping multifamily properties with lipstick on a peg renovations definitely is over. So the long-term outlook, 5 to 7 years, like I said, is very strong. But short-term outlook, honestly, is weak to mediocre at best. So if you're looking to flip multifamily and make quick money by buying a multifamily and selling it in 2 years, tough luck. That's unfortunately not going to happen because we don't see the interest rates moving. We don't see the cap rates moving significantly. So unless you are able to really add tremendous value in your property in 2 years and increase the NOI, which can happen through a very heavy value add deal, that's really not going to happen. So right now, if you're investing in multifamily, you have to have a long-term outlook. And although human psychology dictates otherwise, we have to keep in mind, buy low, sell high. The prices are finally coming to reality. We are seeing at least fair market prices for multifamily assets now. So, which is why I think it's a great time to buy. The best time to buy is near the bottom and early in the recovery cycle, which is exactly where we are at. So all in all, I think it's a great time to buy right assets in the right locations and at the right price. So again, we don't think it's a great time to buy, period. It comes with a caveat. You have to buy the right assets, in good locations and at the right price. Overpaying assets in any market cycle can be disastrous. So my question to you is, what would you rather invest in? AI stocks that don't produce profits today and are purely funded by, investments from primarily the GCC countries, a lot of speculative investments, or an asset class that has been proven and has, stood the test of time for 5+ decades and serves a basic human need of shelter? I think for me, the answer is pretty clear. With that, I think that's all I had for the webinar today. If you have any questions, drop them in the chat box. I don't see any questions. I'm also going to allow you all to speak. That way, if you want to unmute yourself, you can ask questions as well. If there are no questions, then I think we can wrap up.
Yeah, Jay.
Yes, Tim.
I've got a question for you. I think I posted a couple in there. Maybe you can't see those.
Oh, I see them in the Q&A. Yes. Sorry about that. Let's see.
No worries.
All right. Your first question is, what % of deals you look at in today's market actually have positive leverage day one? Or put simply, are you seeing many deals where the going in cap rate is actually greater than essentially the interest rate or the loan constant? Not very often. I mean, it's still quite difficult to source those deals, to be very honest. But at least if we are borrowing, let's say at 6 or 6.5%, we are at least able to find deals at about the same cap rate, right? And in some cases, like the deal that we just closed in November, we were able to find a deal that we bought at almost 7 cap, and the interest rate, long-term agency debt, was 5.4%. So it did cash flow really well day one. But how easily are we able to find those deals? Not very easily at all. So for every 80 to 100 deals that we underwrite, maybe one fits all of our criteria, our buy box, and also the cap rate is actually higher than the interest rate. So it's still pretty rare, but at least now we are finding them. I mean, for the last 3 years, we were not even able to find them. So I hope that answers your question, the first question, Tim. And then I see that the other question that you have is, when securing debt, do you gravitate towards SBL with Freddie Mac, or do you stick with local banks or credit unions? The answer is really either, depending on the business plan and what the play is. We try to stay away from bridge debt. So we even during our entire investing journey, we actually were exposed to no bridge debt at all. And I think that helped us quite a bit. But we typically do the value add deals with local bank debt, and they are full recourse debt. So we personally guarantee those loans. But with local bank debt, we get about 75 to 80% loan to cost. So they are paying for purchase and renovations, which is tremendously helpful. And then once the property is stabilized, we typically refi into agency debt. So depending on the size of deal, that's either SBL or just a conventional Freddie or Fannie.
Okay,
But
thank
if
you.
it's a turnkey property, we have done deals where we just bought the property with agency debt. Does that answer your questions, Tim?
It does. I appreciate it. Thank you.
Awesome. Yep, you're welcome. Any other questions? Okay, I think we are almost at the top of the hour. If there are no other questions, then I think we can wrap this up. We have a few more webinars coming up. We'll be doing this each month. Last Thursdays of each month is when we'll be doing these. The next one that we'll have is actually investing in real estate in general using retirement funds, so SDIRA or 401ks. And then we'll be doing a state of the economy webinar as well the following month. If there are any other questions that come up, or if I can help anyone getting started with real estate investing, I'm more than happy to hop on a call. That's my Calendly link. Let's set aside an hour and do a Zoom call. And even if you're not interested and just are interested in getting to know us, would love to hop on a call and get to know you. That's our website, and that's my direct email as well. So feel free to send us an email too. But other than that, I would just like to thank you all for joining us this evening. It's almost 9 p.m. Eastern. So really appreciate all of your time. And hopefully we'll see you all at the next one. Thank you all and have a great evening. Bye-bye now.